So today we're going to talk about how to position life insurance. Okay. So I always start with educating people first. There are three ways of life insurance, three types of life insurance plans. Let's call this A, B, and C. Option A is term, pure term. You get for 30 years max. Once you get the underwriting approval, your premium, what you pay will never change. It stays as is for 30 years. It's important to know that after 30 years, there's no more coverage. This is called use it or lose it. Use it or lose it. Very important to note. Now let's take a look at option B. Option B is another term life as well, but it has a very important key component. It's called LB. LB stands for living benefits. Living benefits. Life insurance with living benefits. It's similar to option A, also for 30 years. Once approved, the premium does not change, it stays as is. The difference, it has chronic, critical, and terminal coverage. What does this mean by terminal? It means that you cannot take care of 2 out of 6 ADLs in a day. Critical, that's chronic. Critical illness is that doctor has diagnosed you with a heart attack, stroke, or cancer, those type of things. And terminal illness means that doc has given you 12 months expectancy, 12 months to live. I won't discuss too much how to claim. That's a different day's topic. This term is both this A and B, both terms are use it or lose it. Now, what about this option C? Option C is called CVLI, cash value life insurance, and it's permanent. It's 100 years, up to 100 years. And that's why it's called permanent life insurance. You put more premium into option A, you put some portion of the premium that you put the premium, more premium than option A or B. So it's definitely more cost. But some of the premiums that goes into life insurance, part of it covers admin cost. Part of it covers admin costs, and then the remaining money is actually put in index funds. Index funds. What are index funds? These are things like S&P 500, things like global indices like Nikkei, and different indices. Okay. So this particular product has some very interesting feature. Product C, we're still talking about here, the cash value life insurance, because as time goes on, let's say this is we're in February 26, say to Feb 27. Let's say the market is going up and down throughout the year, and we end February 27th on a down market. What happens? If the market is down, negative compared to previous year, you're you get zero or a floor. So there is a floor protection, meaning your money, you never lose money with this feature. Also, with some carriers, they have in some cases they have 0.75%. It floors at 0.75%. So the absolute important thing to note, one of the top feature is this floor protection. The second thing is using the same example, February 27th to February 26th to February 27th, over the period of time. Let's say we end February 27th on an up market. Let's say February 27th, the market is up 8%. What happens? Well, that's the good news, because there's growth here as well. So if the market goes up 8%, you get 8% at the end of this period, February 27th. If it goes up 10%, what do you get? 10%. Get 10%. If it goes 13%, you get 13% as well. But sometimes there's a cap. Maybe the cap is 13. So if S&P goes up 15%, you only get 13%. So again, they give you a floor, but they also give you a cap as well. So there's a floor, and then there's a cap here. You're riding the market up and down. There's the cap. This is how CVLI operates. Now, why do people choose this particular type of products? Well, a couple of reasons. Number one is floor. We just looked at it here. Number two is growth with the market. Number three is that growth tax free. Tax free. 1, 2, 3. Fourth reason why most people choose this type of strategy is that you can gain access to your money tax free. Okay? Very, very important. And that access anytime for anything. You're not limited to, say, education cost or medical cost or certain costs. Anytime for anything. Anytime for anything. Now, how do people use this type of vehicle? Well, people use it for many reasons. You can use it for things like college savings. You can use it for retirement income. You can use it for alternative to Roth IRA. Why is that? Well, some high earners love it because it's got no income limits and no contribution limits. Okay. The fourth reason why most people use CVLI is it's a diversification vehicle. Okay. So, again, college is there. Retirement is there. Alternative to Roth is there. Legacy is there. And diversification is there. Legacy. Family legacy. Okay. So now there's this, I want to pivot and talk about this concept called the X curve. Okay. It's a little bit, this, our X curve is a little bit tilted to the right, but okay. You get the concept. I always talk about the X curve. On the left side, this is called the res, responsibility line. And this is called the wealth curve. Okay. And this is the intersection. So when people are young, they have mortgages, they get things such as mortgage, they have kids running around, kids' education, cost of kids' education, a spouse maybe working or not working, they have senior parents to be taken care of, all these responsibilities and liabilities. If something happens to the primary bread earner, what happens? Because we got the responsibility here, but the wealth is not where we want it to be. So how do we fill this gap? How do we bridge this gap? Huge financial burden for the family. So to eliminate this problem, people use life insurance to shift the responsibility from them to the insurance company. Shift the responsibility. Shifting responsibility. Okay. Now, as time goes, wealth is growing on this line, wealth curve. This is the wealth curve. At midpoint, wealth is beginning to cross the responsibility curve. At that point, people must have term life or term with living benefit. We want to find ourselves somewhere over here with term life, pure term, or term life with LB, option A and option B. But remember, there's a 30-day max year limit on both of these guys, this guy and this guy, 30 years. So how do we solve for that? Well, people worry when I am 55, 65, 75, I may need living benefit. And term may not be there because remember, this is only 30 years. So what do people do? When people are healthy, they take term for the liability side. When they're healthy, they take term. They take it over here. Why? Because the cost is lower. And also, they augment it with a permanent life solution because as they move onto the right side of this curve, they want to have this in place. They want to lock in the cost while they're young and healthy as they're moving onto the right side. Left side is term, right side is permanent, but you want to take this early as the financials allows because the cost is much lower. So now, for most client, we may have term. For most client, we may have a term in place. Okay, we have a term. term, 30 years. And we also have a term with LB, 30 years. But we also, client says, well, they need to have 1.5 million in coverage. What do we do? Well, we do something like this. This is permanent, 100 years. These two are 30 and 30, and this is 100 years. So for 20 years, this is 500, okay, 500K, 500K. So that's 1.5, okay, million. So for 20 years, the client has 1.5, or 30 years, the client has 1.5. Then after 20 years, that option may end, or 30 years, that option ends, and the permanent continues. So permanent continues, continue. Okay. By then, the plan grows. So that plan is, the growth in this plan is going to be used for tax-free retirement, long-term care. So tax-free retirement, long-term care, because this is when we're much older, and we're likely about 70% of people in the United States who are hitting age 70 are going to start needing some form of long-term care. So we need that in place. And then we also need to cover for legacy. Okay? So that's how we position life insurance for various clients. Term on the left side, on this left side, it could be 20, it could be up to 30 years. Low cost, but temporary. Because as we're growing our wealth. Permanent is mostly for the right side of the curve, because we want to secure this permanent here on the left side. So as we move in age toward the right side, permanent is permanent. It's locked in. And so really the way to look at it is that the combination of A, B, and C here, term 20 or term 30 and permanent 100 years, solves basically everything. It solves this problem here, and it solves this problem as we get later on in years. Does that make sense?